Good morning, everybody. Thank you very much for joining us for our latest edition of TAM Talks. This is quite different from our previous TAM Talk webinars, where today we're not actually going to have a presentation as such. This is really built around questions from you guys, the IFA community. We have had quite a few questions come in already beforehand. So what we've done is we've worked on those and collated them and made sure that we're answering as many of them as possible in the right amount of time. You can also keep sending questions over during the webinar as well, just via the questions tab, which should be on the right of your screen. Today, I'm joined by TAM CEO Lester Petch and TAM CIO James Penny, who are going to endeavour to answer all of these questions for you. You can also rate this webinar and leave feedback, which we really do appreciate. But I'll leave the formalities there and we'll get straight into the questions. So let's go to the first question that I've got here. It's actually a really pertinent question in today's market, is what is TAM's approach to risk management?
Thanks, Joe. Thank you, everyone, for dialing on. I'll jump right into it. Risk management. Risk management's the single biggest question that we get asked by advisors. What is our approach to risk management? I think it's really pertinent, as Joe said, given where the market is, given where we've been in a massive bull market. Without Q1 in 2020, it's been a bull market ever since 2008. So you've been rewarded for over risking your portfolios, but that's not okay. It's not okay to over risk your client portfolios. Risk management for us is sacrosanct, is paramount. When we design a client portfolio, when a client invests with us, they're investing onto a risk profile. They're investing onto a risk mandate that we will not breach. Risk governs portfolio construction, it governs asset selection, it governs fund research. Everything that we do oscillates around risk management. We look at the benchmark that our portfolio is against, and we seek to never go over the risk, or we seek to track the risk of that same benchmark whilst outperforming it. That is essentially the mandate that we have. Now, the internal goal between my team is to outperform the benchmark with less risk in the benchmark. And I'm happy to say, over the last 10 years, that's something that we've been always consistently able to achieve, which is really good. So that's a good alpha number. But risk management, to answer the question specifically, is set out via the benchmark that we have. The benchmark that we have is the FTSE All Share, is the FTSE All World, and then we have a government debt proportion, which is the UK gilt and global government debt. So those four parts make up our benchmark. And what we do is we use a composite benchmark of those four parts to arrive at a benchmark that we can use as representative of our portfolios. And the risk that is produced from that benchmark is what we seek to track. The metrics that we use to assess risk within the portfolio come from FE. FE have a risk score for our portfolio, and we seek to have that underneath the same FE risk score for our benchmark. We use metrics like value at risk, at 90%, 95%, and 99% certainty over 1 month, 3 months, and 1 year. We also have straight volatility measures. We have standard deviation measures. We have alpha. We have downside capture, upside capture, R squared. The list goes on. But what I want to reassure you is that TAM's approach to risk governs everything. We must make sure that the portfolios that we run, the portfolios that we offer for clients, are in line with the risk mandate that they are happy with. At the end of the day, I see it, my team see it, we're stewards of capital. We need to make sure that we are looking after our clients' investments from start to finish. It's as much about securing that goal, that financial goal that a client wants at the end of their investment life cycle, but making sure that the journey through that investment is smooth, is risk adjusted, and we make sure that we do that. I hope that answers risk without going into too much detail. But as always, if you want me to go into any more detail, please do come. Please come and have a chat with me. Please ask me.
Brilliant. Thank you, James. Just keeping on the subject of risk, as we are a defensive asset manager, one big question that's been sent over quite a lot is, where do we see the biggest risk moving into Q4 in the financial markets?
The biggest risk in Q4 is quite evident for me. The biggest risk in Q4 is that we slip off the merry-go-round. The merry-go-round that's been basically Q2, Q3, Q4 of 2020, Q1, Q2, and Q3 of 2021. It's been a phenomenal time to be an investor. Our portfolios have done extremely well. The market's done extremely well. Balanced accounts, growth, adventurous, all accounts through are looking extremely good. And predominantly speaking, the returns that we've seen this year are over the average. Now that's fantastic. I'm very happy with that. But the risk in Q4 is that party comes to an end, that the market starts to become more volatile. And we're even starting to see that now. The volatility is creeping back into the market. The VIX, which is a standard measure of volatility, is starting to spike, and then it's starting to retrench and then spike again. So if I can word it like this, the volatility of volatility is starting to increase, which shows the market's getting quite skittish. That's something that we need to take note of. But the biggest risk in 2021 is that Q4 might hold a sell-off for us. It might hold the moment where the world goes, you know what, maybe this economic recovery isn't as strong as we originally thought. Maybe the Federal Reserve, maybe central banks are going to start to taper. Maybe they're going to raise interest rates sooner than we thought. There's many shocks. And the reason that those shocks might have a large effect on the markets is because we are at such elevated levels. There's such euphoria in the market when everybody is thinking in the same way, which is brilliant, brilliant, brilliant. Let's buy. That's when you get the risk. That's when you get people going, actually, hang on. Is this correct? Let me just re-question my euphoria. And then sometimes you can start to see a pull-off in markets. Now, as I've been saying to our clients, that's not a bad thing. If you have a retracement of markets in Q4, that's not necessarily a bad thing. It's good to let some air out of the bubble. It's good to let some air out of the market because it means that we can start from a lower base in 2022 and we can start to move higher again. So we don't obviously want to see 20, 25% coming out of market. But there is a risk in Q4 that the all-time highs that you're seeing in Europe, in the FTSE 250, in the S&P 500, and various other markets around the world, whether it's commodities, timber, if those start to come off, then we think that might be quite a good thing to the order of 5, 6, 7%. But again, we need to make sure that the client portfolios are prepared for it. So yes, there are risks in Q4, but if we can try and get ahead of them, then that's something that we can do for our clients. And that's something that means that we can take profits where we can, take profits where necessary, and we can set them up for 2022. Again, back to my original answer of the first question, we're stewards of capital. It's about that investment journey. We need to make sure that we're managing the long term through a period of short terms. And Q4 2021 has the potential to be volatile, considering how aggressive the market's been, that acceleration.
Joe, I think you were on mute.
Apologies, I think it was on mute there. Some technical difficulties. Sorry, James. Keeping in the same vein there as what we were discussing, you have growth stocks, value stocks. Do you think that we will see a reversion in 2022 from growth to value as COVID concerns lessen?
So I was being asked the same question in Q1 of this year, when value was accelerating and growth was pulling back and inflation was moving higher. There's a lot of different parts to this question. There's a lot of different parts to answering it. Where do you think inflation's going to go? Because inflation is a massive driver of value stocks, and it is a headwind to growth stocks, predominantly because growth stocks, as their name, have all their growth in the future. Now, if you've got inflation, those future growth earnings are going to be eroded. So you want earnings in today's world. So that would push value forwards. I do think inflation is here. I do think it is, I don't want to use the word here to stay, but I do think it's going to be a little bit more resilient than people are giving it credit for. I think the market is still buying into the narrative that inflation will be transitory. I think in 2022, you're going to, if I can be honest, you're going to have a continuation of what we currently see, right? Which is where you see inflation prints higher and then inflation prints lower, or maybe you get an inflation spike in the UK and you get an inflation pullback in the US. I think you're going to see peaks and troughs. You're going to see times when value stocks start to rocket because people are worried about inflation. People are worried about the Fed raising interest rates, which are both good for value stocks. And then you see points when maybe people are skeptical about that. And then growth stocks start to push forwards as people believe that inflation will be transitory. I don't believe 2022, and I might be wrong, but I don't believe 2022 is going to see value massively shoot ahead of growth. I think there are some structural reasons there as well. I think this market and the type of investor that's in this market is extremely interested in growth stocks. They're extremely interested in the future earning potential of newer, smaller, more innovative companies, definitely in the ESG space. So there's an underlying driver of interest towards growth stocks. I don't believe that's going to abate in 2022. You will see some value strength as people worry about inflation and they continue to grapple with it, because there's no clear-cut evidence that inflation is here to stay or inflation is going away anytime soon. I must tack in the oil price. The oil price is a big indicator of CPI, of inflation. So we're going to have to keep an eye on that as well. So there are many different factors in the conversation around value versus growth. What I will say is my approach to playing 2022 is to make sure that I have the best of both pots, right? I've got some phenomenal growth funds in the portfolios which do extremely well, which have done extremely well over the last decade, invested into that growth rally. But I've also got what I believe to be some of the best value managers in the world in the portfolios. And I'm very, very, very happy that if there was a value rally, a big value rally, those guys would be at the front. Those guys would be first quartile. So we've got both of those. But where I think the main part of the market will be in this conversation about growth and value is in the middle. Now, I call that the high quality sector. I call that companies that don't have all their earnings today. They have a little bit of growth and it's robust. They have a good level of income. They have a good return on equity, low levels of debt. They've got good franchises, strong barriers to entry. It's just a good business model. Now, that's akin to mid-cycle investing. And I believe that's kind of where we are with the acceleration in 2021 and acceleration in 2020. In the market, a lot of the market looks like we're mid-cycle right now. So I think investing in high quality companies that capture a bit of both, as well as having really, really effective value managers and really, really effective growth managers, that gives me a really nice niche bucket of investments that clients can be invested in to capture whatever 2022 throws at us. Because it could be both, but we'll be keeping an eye on the metrics. And if we start to see inflation moving higher, then that's something that we can reflect in our asset allocation. We can increase our value exposure. And if we see things moving the other way, we can obviously adjust to that. That's the beauty of diversification.
Brilliant. Thank you, James. We are having a fair few questions come through on the live Q&A tab now, which is great. Please continue to send them over. We'll endeavour to answer as many as we can. First one that I'm going to pick off here is, are interest rates likely to rise when quantitative easing is still in full flow and only considering tapering now? Surely interest rates in the major economies won't change until quantitative easing has unwound. Thoughts?
So that's a very good question. It's a question that's on the mind of almost the entire market. Tapering has to come first. Tapering will be first. The latest Bank of America survey suggests that tapering is going to happen this year. That is central banks stopping quantitative easing or tapering the amount of bonds that they are purchasing. Do I think that they will stop 100% before they start to raise rates? Very probably. I think that it doesn't make sense from a central bank perspective to be pumping QE and raising rates. They work against each other. I think quantitative easing will be tapered, and then it will be stopped, and then you'll have a gap, and then you'll start to see interest rate rises, with the caveat that the economy must be able to handle it. They're not going to do it if the recovery is still fragile. If inflation is looking like it's going to come off, if consumer sentiment surveys aren't very strong, if spending numbers aren't very strong, if you have signs, especially in the labour market, that the economy's not ready for rates to be risen, then the central bank won't do it. And they might sit there in that middle ground between having tapered, having finished their bond purchases, and waiting for the interest rate rises. Now, there are many in the market that argue that the Fed and central banks just can't raise rates. We live in a new paradigm. We live in a new world where the whole global economy cannot stomach higher rates. And in that respect, the bond market's not going anywhere. It's going to stay at this level for a long time. It's not going to sell off because central banks have painted themselves into a corner. At the moment, looking at interest rates, they are pegged for 2023. Now quantitative easing should end in 2020. Well, quantitative easing will be announced in 2021. It will happen in 2022. The velocity or the trajectory of that quantitative easing tapering will be governed by the numbers, will be governed by the economics. And only once you've seen that embed itself, then you might see the prospect of interest rate rises. But it's very much up in the market. Anything that's up in the air is usually not priced in. So keep an eye on the numbers, keep an eye on the announcements, because that will definitely move market.
Thank you, James. I'm going to drill down a little bit into individual assets, if that's okay. First question, and we've had this quite a lot from IFAs, is what are your thoughts as a team on property funds?
Sure. So property funds are, I think if we all remember back to 2016, 2016 had a huge run on property funds, and you started to see physical property funds gate. Now that's something that TAM never wants to see in its portfolios. I do never ever want to invest in a fund that gates. There's too many options. There's too much variety in the market for us to invest client assets into things that have liquidity problems. So the first observation about property funds, and not the property market, but property funds, especially in physical property, is there's still a lot of illiquidity. The property might be the property might be sound, but the investment wrapper is subject to client withdrawals and is subject to sentiment. And if that gates, that's just unacceptable. So property funds, for me, physical property funds, are still not concrete enough. They're not sound enough for me to invest in. They're a good diversifier, and you do get that 5% yield a year annualized on just clipping the rent that you get from the people that rent your buildings. But it's still governed by sentiment. And the FCA came out, last year and said, fund managers of property funds are free to gate their funds at will if they have done a valuation of their properties and it moves within a certain, it's becoming volatile. If the price of the underlying property is volatile, you're free to gate your fund. Now, that for me is just, no, I don't need to be there. There are other much more robust, much more liquid alternatives that I can invest our clients' assets into without that risk of being locked in, of illiquidity. So that's my view on property funds. I'm waiting. There are obviously REITs where you buy the equity of property companies. They come with their own challenges. They come with the fact that they are equities and they are subjected to equity volatility. Now, where we are with the market at all-time highs, is it the right thing to do to be increasing my clients' investments into the equity market? Not at the moment. So I need to see a little bit more stability there before those REITs also become attractive. I think the property market in and of itself, especially the commercial property market, is, that's been the preserve of every conversation in every UK household for the last 2 years, what's happening to property, what's happening to commercial property in cities, what's happening to London. I think it's still up in the air. I don't know what offices are going to do. I don't know if companies are going to be downsizing. I don't know if they're going to be looking for properties outside of London. Maybe the play is to invest in the Manchesters and the Liverpools and not in the Londons. It remains to be seen. COVID is still too much within our midst for us to be able to see a clear path to the trajectory of commercial property right now. It definitely looks like what COVID has done is brought up a huge amount of Amazon spending and e-commerce. So I think there's a lot of potential within those big hubs across the UK that can service that e-commerce. I think that's very attractive. But again, the wrapper right now, the investment wrapper for property isn't attractive. It's not liquid enough for our clients. And going back to risk,
if I could add just,
I'm not prepared to take that risk.
If I could sort of add something there, just anecdotally about our history in property funds, which shows you the dilemma we have with financial advisors and clients. Back in the day, in the first locking of property funds, I mean, we had fairly strong property positions in the months leading up to that and wound them down very successfully over the course of 3 or 4 months. But we ended up with just a little bit of a weighting left. I mean, let's say just anecdotally, it was maybe we had 20% in property because it was a good time for property. It did very well for clients. We gradually peaked that down and down and down, and we ended up with a very small weighting in some elements of our portfolios. You would not believe the, inverted commas, grief that one was taking at the time about why is my fund locked? Why can't I get my money back? So TAM at that time took a very distinct hard line really on saying we are not going to buy anything we consider could even go illiquid. It's something we just feel all clients don't want, unless they're in a very, very long-term pension situation. There is no movement in that. Perhaps maybe it's a big account and they can afford to do it. It's something that you as advisors can work with your clients on. But from TAM's perspective, illiquidity is unacceptable, and everything we buy, we believe, has the highest chance of remaining highly liquid because we want clients to have their money back when they want their money back. I think that summarizes it.
Thank you very much. Next question is, what are your team's thoughts on cryptocurrency?
Crypto. Everyone loves a conversation about crypto. So my view on crypto is this, and it goes back to the dot-com bubble. As we are right now on the internet has become the backbone of society. It's become the backbone of e-commerce. It is the backbone of the economy. But you still have the dot-com bubble. And I believe that even the very best ideas, even the most disruptive ideas, even the ideas that will shape and form the economy of the future have to potentially go through a bubble before that euphoria gets washed out and they can be taken seriously. I do believe that is akin to what's happening in crypto right now. I do believe that digital currencies have a future. They have a place in our future. Not many people spend cash anymore. Everything is done digitally. There is definitely a place for crypto. I believe that it's going to be heavily regulated. I believe that central banks will design it in their image. They will design it in a form that they can control. Governments will do that as well. Crypto will have a place, but it needs to be reshaped before it can have that place. And I believe the front runners now, your Bitcoins, your Ethereums, they've raised the question. They've tabled the discussion. But I do believe the market, my call is that the market is currently in a bubble. There is a huge amount of euphoria around it. There's a huge amount of speculative, social media-led buying of cryptos that is not necessarily that informed or professional. And it's distorting the price of what I believe will be a very interesting future market. There are other sideshows going on, like blockchain, cloud computing, which will go with it, which are very, very interesting. And our team are investing and looking at those areas because they really, they're not in bubble territory. but they will support cryptocurrencies. In the gold rush, the 1800s in America, the money wasn't made starting your own gold mine. The money was made sitting on the side of the road, selling the picks and shovels to those people going and chasing their fortune up the road, up the mountain. That's what I believe the blockchains and the cloud computing investments are going to be. They're going to be supplying the infrastructure to everyone piling into that market. So yes, cryptocurrency in the future, absolutely, I see it has legs. But right now, I believe there's a huge amount of euphoria, which is distorting the price. That needs to be washed out before we'll take it seriously.
Okay. TAM is the DFM. We run model portfolio service. A question we still get asked quite a lot is, what are the difference between an MPS, multi-asset solution, and a multi-manager fund solution? Is there anything that you'd like to say to that, James?
Yeah, of course. It's the different structures. A multi-manager is what we do. We invest in high quality managers. So does a multi-manager proposition. It's the wrapper. To me, it's the wrapper that the products are in. So when clients come to TAM Direct, they buy 5% of Fund A, 5% or 6% or 3% or 10% of Fund B, and they own the units of all of those individual funds. That for me is the MPS, right? That's what TAM does. Now, when you move into multi-asset funds, multi-manager funds, the word fund is there. So you've got the same strategy of buying high quality managers, but it's wrapped up within a fund. So it's unitized, which means that if an IFA were to buy TAM, their clients would own a sleeve of every single underlying fund. They would have units in circa 15 different funds. When you buy a multi-manager fund, you have one unit. You just buy one unit, and within that unit represents the price of all of the underlying funds within that strategy. So it's a different approach. It's a similar underlying strategy, but it's a different regulatory wrapper. One is owning all of the funds. One is owning a unit that represents the price of all of those funds. Obviously, one is a fund that can be purchased like a unit in any way across the market. TAM Direct, to get exposure to TAM, you have to come to us direct or via a platform to access that.
Brilliant, thank you. We obviously have ESG portfolios as well as our mainstream portfolios. Within our ESG portfolios, a big question that we get asked all the time is, do we as a DFM target specific UN Sustainable Development Goals?
The answer to that is we leave the benchmarking, we leave the targeting to funds. My job is to build an ESG client, the very best portfolio I can, that captures the widest part of the ESG market, the ESG market, the active market, the impact market, the ESG market, the ethical, the social, everything. We want to make sure that the clients have the biggest range of opportunities across the entire spectrum, to give them not only the widest possibility to have their pound make an impact in that market, but also to get the best returns. At the end of the day, we're investors. We want to build the best portfolio for our clients. Now, that's not necessarily tracking the UN Sustainable Development Goals. Bailey Gifford Positive Change is one of the best funds we have in our portfolios. That tracks UN Sustainable Development Goals, and I'm very happy it does. But there are some other funds that do not. There are UK ESG funds that do not track the UN Sustainable Development Goals. They track other goals. They track other widely held benchmarks. Now, am I not going to hold those because they don't track the UN? No, because I believe they're fantastic investments. I believe that they are making a difference, even though they're not tracking the UN Sustainable Development Goals. My view is, if there was ever to be a industry-wide ESG benchmark, it would likely be the UN Sustainable Development Goal. But the market is still in its infancy, and it doesn't quite have that maturity to have one standardized benchmark, which means that my funds, I'm not going to penalize funds for not tracking that benchmark. There's still not enough commonality yet in the ESG market to form a consistent approach to answer that question. But that's to the benefit of clients, because we are not going to impact them by only looking at certain types of funds.
Keeping on the subject of ESG, another question that we get asked a lot as a team is, how do you ensure that the funds within your portfolios, your ESG portfolios, remain fit for purpose?
It's a critical question. It's fundamental. How do you make sure that the team running your MPS or your multi-manager are keeping an eye on the investments, especially within ESG, because clients need to know that the capital they're putting to work is making a difference. The capital that they're putting to work is doing what they want it to do. What we do is we talk to the fund managers as a hard rule twice a year. We monitor their performance daily, monthly, weekly. But we also look at the news flow around that fund. We look at what the fund is buying and selling. We normally do that within the formal interviews with the fund managers. We make sure we keep an eye on that fund. Are they being honest? Are they sticking to their mandate? Because the mandate is what we bought. If we think it's a fantastic fund on day one, we want to make sure that that fund is a fantastic fund on 5 years plus. We need to make sure that they're sticking to their mandate. So that's what we do. We make sure that we are reviewing the funds, interviewing the fund managers on an ongoing basis to establish if their purchasing track record, if the way that they're buying and selling companies and what they find attractive about those companies from an ESG perspective is still rock solid and watertight and as rock solid as the day we bought it. That's what we're looking for. We're looking to make sure that they are sticking to their mission statement. Any drift from that, if they start to move away from it, if they start to hunt down opportunities that aren't necessarily ESG focused and more market focused, that's a red flag for us. We want to understand why their ESG process has fallen down. And in some instances it has, and we've immediately sold that fund because we don't believe that their ESG criteria, their filter's changed. It's not what it was when we bought it. So we don't know what entity that fund is anymore. We can't put our finger on that fund and we can't put our hand up and say, this fund is a fantastic fund. This fund is perfect for our clients. So we take it out. There are many, many fantastic funds out there, and there's always a really good alternative. So we want to make sure that we're doing the best for our clients by monitoring exactly what they're doing and making sure that they're sticking to their mandate.
Another point that we have on ESG is, do you see a future of passive investing within ESG portfolios?
Tricky. Again, some great questions coming out here. Passive investing is investing without an angle. It's investing broad spectrum. Let's just buy a section, whether that's a market, whether that's a theme, and let's own everything in that sector. It's akin to negative screening. It's akin to, well, I'll just own the FTSE 250 and I'll just screen out everything that isn't ESG. For me, we're better than that. We're better than buying an index that's just had a certain few companies stripped out of it because they might be oil, gas, tobacco. We're looking at impact. We're looking at how can we put a client's assets to work, rather than just owning the FTSE 250 without oils, banks, and mining. So for me, passive investing is still not sophisticated enough in the ESG space to deliver me that impact. I want to measure my client's pound, right? Bailey Gifford, positive change, another, giving that fund a bit of airtime. That I can measure the impact of the pound that I'm putting to work. I can't do that within a passive portfolio as accurately. And I think that's something that we should be delivering as a model portfolio manager, as a professional ESG investor. We should be looking at the forefront, the cutting edge of investing in the ESG market and giving clients that cutting edge. I'll give you an example. Impact investing, I believe, is something that's phenomenal. And I believe it's probably at the forefront of ESG investing, which is buying a stake in ExxonMobil, a big oil producer. 99% of the world would say that that's not an ESG investment. Well, if your intention, like Engine One, the fund management house, if your intention is to buy a stake in ExxonMobil so that you can start to, from the board, down, implement change from the board down, and get that company to change its ways, get that company to stop investing in fossil fuels and start investing in renewable energy. Isn't that amazing? Isn't that turning the dial on the most ineffective parts of our economy and making them greener? That, for me, is a phenomenally interesting part of ESG investing, where a client's assets can be really put to work in making a difference. Not just owning a green product, but actually making the economy, making the world more green via impact investing. You don't get that with a passive product.
Brilliant. Thank you, James. Our model portfolios are available on a wide range of platforms. We're currently on 7 third-party platforms: 7IM, Eccentric, Aviva, Embark Advanced, Novia Global, Transact, and Standard Life. A question that we do get asked very, very frequently is, why not make your portfolios available on as many platforms as possible? Surely that would help you to raise assets and not limit the conversations that you can have.
TAM is a flexible entity. TAM is a specialist in delivering direct portfolio services, coming to us direct. What we do, our approach to platforms, is that we are advisor-led. Advisor demand influences where we open up our portfolios to. So if we see advisors, if we see a lot of demand, if we see our clients coming to us saying, this is a platform we're really interested in, we will engage with that platform. Now, you get some platforms that say, I'm sorry, you don't have 20, 30 million of assets. We're not going to give you a place. Sometimes it's not always up to TAM which platforms we go on. But again, we talk to some platforms and we say, well, this is our portfolio. And some platforms will say, you can't have any of those funds because they're not on our platform. So then TAM has to build an entirely different model. So sometimes there are growing pains within the platform world that make it not effective for TAM to be on everything. But what we do is we take very seriously our existing clients and our future clients' needs in terms of platforms, and we seriously evaluate it. And almost every single platform that we are on, which is quite a few now, has been because of our relationships with our IFA community. And they've come to us and suggested that we look at this, and we've done it, taken it seriously, and we've opened up our portfolios on them. Now, that may continue to happen in the future. And this time next year, we may have even more platforms that we're engaging with. But we don't take a shotgun approach to getting on everything. We take we will outsource our specialty to platforms if it's required. But our specialty is very much direct.
You've mentioned the direct custody piece there a couple of times, and we will go into a little bit more detail in a minute on our direct custody piece. But the next question that we've got is, TAM manage, as well as mainstream portfolios and ESG portfolios, we also manage Sharia portfolios at TAM. Now, the Sharia portfolios are only available on our direct custody offering. They're not available on third-party platforms. A lot of people would like to know why that is.
One of the main points about having a true Sharia fund is the cash account, right? So one of the hard rules of Sharia investing is you cannot generate interest on your cash, on your capital. So if you had that in a traditional bank account, that's not a Sharia compliant investment. It's not a Sharia compliant bank account if you're generating interest off it. And as long as interest rates are positive, you're going to generate an interest. So what TAM has done direct is we partnered up with a bank, a Sharia specific bank, that can hold client cash and ensure that no interest is accrued within it, which makes it a Sharia cash account, which is critical. Now, if you went to a platform and said, what Sharia cash accounts do you have for me to put my Sharia assets in your custody account and make sure that they don't accrue any interest? Platforms are just not set up for that, as we've seen at the moment. Now, I may be wrong. Please do email me in if you know a platform that has a Sharia compliant cash account, but it's something that we can't find. So we're putting our portfolios on, we're putting our Sharia portfolios on platforms, but they're not. The value, the core metric is being eroded as to why they're Sharia accounts. And also, Sharia funds are very niche funds. They're not necessarily, some of them have only just opened up. And so when we go to certain platforms and say, well, do you have this Sharia fund on? A lot of the time, sadly, it's no, we don't have that Sharia fund. You can't have this Sharia fund. Well, if a 7IM only have 2 of the 12 Sharia funds that make up our Sharia MPS, and they have no cash account, it's not a sustainable venture for us.
Thank you, James. Yeah, I think it's worth also pointing out that TAM is open to conversation on a whole host of points, whether it's with financial advisors, whether it's with platforms, whether it's about helping to facilitate Sharia investments on platform, etc. We're always open to dialogue on those sort of points, and we welcome them. I think we'll maybe make this the last question. We'll see how we go for time because we're over 41 minutes now. But this is a big one for TAM, and we do get this every single meeting without fail. What are the benefits of using your portfolios directly on the direct custody piece rather than via a third-party platform?
TAM is an investor, but it is also very focused on relationships. It's very focused on that service to IFAs, which is essentially value for money. What is value for money? TAM's designed its entire investment proposition around value for money. And it's not just getting a portfolio. It's not just having an investment service, because with respect, there are many people out there that deliver an investment service, and you'll find them on platforms. And TAM on a platform is just another manager. But what is TAM's value for money? Where does it really add that value? Yes, we outperform the market with lower risk, and our performance, we believe, has been excellent. Please do go and check it out on FE. Those are great. But where we really add the value is in our communication to IFAs, whether that's through easily accessible MiFID reports, whether that's through completely tailored client investment reports, whether that's through CGT calculators and CGT management, whether that's every single trade on every client account I've ever done in my entire career at TAM has a specific narrative written that's attached to that trade. Every client we have can go into every position in their portfolio over their entire investment horizon and look at why I bought it, why I sold it, why I topped it up, why I trimmed it. It's a wealth of information that they can read up on, that they can look into and understand how their portfolio is evolving and progressing. Again, going back to that first question about the experience, the investment journey, we want to create it and make it as smooth as possible. And that's a massive amount of information transfer. We want to make sure that the client is as informed as possible. If you bolt that on to proper portfolio, risk-adjusted management, good alpha numbers with very competitive fees, that, in my opinion, and happy to debate this with anyone that wants to, that forms the basis of value for money. And that is the center, that's the core thesis of why we're here, is to deliver clients a really proper portfolio with maximum information download. And when you go on a platform, you don't get the narratives, you don't get the investment service, you don't get the MiFID reports, the CGT calculators, you don't get TAM's investment expertise when they go out to the market. And because we have a very good relationship with funds will offer us the opportunity to invest in new products that have yet to come to the market that we can help launch for them. Now, in return for that, TAM gets access to extremely competitive share classes of funds. Now, if a normal institutional fund was at 0.78% as an AMC, for seeding an opportunity, for helping a fund launch, you're looking in the region of between 30 to 40, so 0.3 or 0.4. That's a significant discount to investing in a fantastic future fund that we believe that our research has shown us should be as good as any of the top quartile funds. So TAM can invest in phenomenal boutique managers at steep discounts on AMC, which makes our portfolios extremely price competitive. Now, again, if you go on a platform, you go onto 7IM and say, well, we've helped launch this new fund. can you put that share class on your platform for our platform investors? And sadly, the answer sometimes is no from those platforms. They won't do it. So the reason why clients like coming to us direct is because of that huge information service, that huge value for money push that we do, and also that much more price competitive portfolio that we can deliver. Obviously, the portfolios that we design on platforms are akin to and every bit as good as the portfolios that we design at TAM, but we don't have control over the types of share classes that we can own. So it does us a little bit of drift there. That's why our direct offering is so critical. That's why our direct offering is what we've spent the last decade plus working on and honing and making sure it's exactly what advisors want. It really is it's the true value for money play that we've been working on. I hope that answers it. There's always more points to this question. And, if you ask this direct, I could probably spend 2 hours talking to you about it and laying it out. And I'd love the opportunity to do that if you want to come and talk to me more about what we can actually deliver direct. But in the 5 minutes that I have to sum it up, that's probably the best I can do. I apologize if I've skipped over points.
No, James, that was absolutely great. Thank you for that. We've been having comments come in from people talking about trade narratives and how they are received by their clients and how much they help cement relationships with their clients. Also had a lot of positive feedback. They're saying they appreciate the straight talking style that you've delivered the answers with. So again, thank you very much. I really do appreciate it. We're probably going to Sorry, just muted myself by accident. We're probably going to look to wrap up there. But I thought I'd give you both an opportunity to just end on, if there's one point that you wanted people to go away from today's presentation with, just one point, no matter how long or short it may be, what would it be?
Okay, I think James has ended on exactly the right point there. So it's good for the people that are listening. It's that what we've tried to do is create this huge value for money company that gets down to the lowest possible pricing levels for clients, because we all need to be at a level at which that we can present to our end clients the best packaged offering at the lowest price. That doesn't mean it's the worst price. There are always something you can do to make something cheaper, but when you're adding this type of quantum of data, delivery of investment service, this whole question of value for money is going to hit our industry hard over the next 12 to 24 months. But that's what we're striving to do. So that's my point.
Brilliant. Thank you, Lester. James, is there anything that you'd like to say just before we leave? Sorry, I know you've done a lot of talking. Just one point, if you have it.
Hey, I love talking. Value for money. I'm sorry to go on about it, but what is value for money? What is the service that you're receiving, and is it giving you proper value for money? Because that's what we are. That's what we focus on. That's our core, is delivering proper value for money for clients from start to finish. I won't stop doing it. I'm obsessed with it because it justifies our existence. And that's all TAM will be doing, is focusing on that drive for value for money. And that governs everything. So please take that away.
Brilliant. Thank you very much. One thing that I'll close on as well is TAM is a very easy company to talk to. If you're a financial advisor and you want to discuss anything about what our approach to the market, our approach to investing, how we can help you, even development of particular assets. We've got an 8-year track record on ESG portfolios and a 7-year track record on Sharia portfolios. We only got those through dialogue with the intermediary community. So that's something that TAM's really built on. So if you need to get in touch with TAM, please get in touch with myself or one of the business development team. And in turn, I'm sure that you'll be able to have conversations with James and or Lester at some point as well. Very easy to talk to, not a lot of red tape within TAM, so you can get the answers and the conversations that matter to you and your clients. But apart from that, thank you very much for your time today, guys. Please remember to rate this presentation if you feel inclined to do so. Any questions that you have, again, please get in contact with us. We're absolutely thrilled to talk to you guys. But yeah, any feedback that you want to leave on here as well, it really does matter to us because it helps us shape any future presentations. But yeah, thank you very much, and I'm sure we'll see you again soon. Bye-bye.